Good afternoon and welcome to another installment of Research That Matters. I'm Jasmine Guerra and I'm a Finance and Management dual major and a Parker Scholar at the Parker College of Business. Today, Dr. Katie Pham, an Assistant Professor of Finance, will share a discussion about her research and how the general community can benefit from her findings. All right, thank you for joining me, Dr. Pham.
Thank you for having me.
All right, let's just start with our first question. How did you become interested in this topic?
The board of directors is actually central to a lot of my published and ongoing research. And I find it very interesting because, as you know, a corporation is formed with the idea that there could be a separation of ownership and management, right? So, like we got the news just yesterday that the CEO of Amazon is stepping down. And he's a founder of the company. He's the owner of the company, right? But the reason for him to be able to step down was because, we have a corporation with its own structure, with own legal identity, and we have the owner, they are separate entities. And so the idea of the corporation is to have the ability to separate ownership and management, and that allows for the owners not having or can choose to not run the company directly. And so in order to do that, the owners kind of have to trust somebody, right, with the work of monitoring or advising the CEO, and that's the board of directors. So I feel like it's very important from an investor perspective to look at how the board functions, how that governance structure is actually governing the firm. Is it effective? Is it aligned with what the owners of the firm wants? And so I think it's very interesting to look at the board of director functioning, how they are, how they do their job, how they got paid, how they are incentivized to do their jobs, and things like that. So it's driven me from, first day coming into the field, is the question of, how they work, how they help the owners, the investors of the firm, to monitor the firm, to work with the CEO. What is the power balance between these parties? And that still remain, a lot of things that I have a question on, and I don't think that it has been addressed. So that bring me to, researching board of directors and, the kind of the relationship between them and the CEO of the firm.
And then can you briefly summarize your research project and its conclusion?
So in this particular research, me and my co-author, we are looking at how the compensation of the board of directors is determined. And why is it interesting? Because we have a rare instance where the board of directors can actually set their own compensation. So imagining you're a worker of a firm, right? You go in and, you do an interview, you got hired. Your pay is determined by a third party, and you can negotiate, but it doesn't mean that you can have 100% of the say in what you pay yourself. So in this setup, the board of directors actually have the control and are in control of what they got paid, of what kind of work they want to do, and then how they want to monitor the CEO of the firm. So we kind of look at this as a situation where this group of directors can potentially act opportunistically, right, to rack up their pay, to charge up the pay, because they decide to pay themselves, and they don't need a say from the investors of the firm or the owners of the firm. They are representative of the owner. They get to do what they were. They get to do what the owners decide that they can do that. So they do ask, but they don't have to get 100% approved by the owners of the firm with regard to how much they paid themselves. So it created a very interesting setup. And we do find that these directors actually kind of game the system and try to charge up their pay. And the way they do that is through a strategic selection of a group of peer firms. And so in the usual setup of, at the top of the corporate ladder, you got into the labor market where, your pay has to be competitive. If not, right, the executive can say, if you don't pay me enough, I'm going to go work for another firm that pay me better, right? That I have the skills that are so desirable that I get to choose where I work. So if the firm doesn't pay enough, right, then they cannot hire, they cannot retain those very talented, executives. So at the top of the corporate, it's usually that they kind of justify the pay by saying these are the rival firms that we are looking at, and so they are currently paying their executives this much and that much. And so directors do the same thing. They say, oh, here's the group of peer firms that we determine that have a very close relationship or very similar to our own firm. And so this is how much they pay their directors. We were just trying to benchmark or paying the same thing. And so here, right, it creates a situation where you can have, you can, as the one who decide, right, you get to choose what peer firm you put into this group. So you can essentially pick those peers that actually pay their director higher. And that will help with, increasing their pay. So that's the main thing that we found.
Very interesting thing how they could possibly have play in what they'll be paying, possibly with any manipulation with that. But what does this mean for business, and how can people in the business community benefit from this kind of research with it becoming public access?
I think from a business owner's perspective, you got to be realizing that the current governance structure has some flaw. And it's not perfect. There is a loophole that those people that you think you can trust with managing or advising the firm or monitoring the management of the firm can actually manipulate some of their activities or some of their decisions so as to mask, right? That it's not actually it's self-dealing, and it's kind of can mask the actual benefits that they gain from those. So what a business owner should really look at these research and know that what is the flaw of the current system. And if there is such a disadvantage or a loophole like that, how would you be addressing these and kind of minimize the impact of those, kind of loopholes? And really emphasize on the selection of people for the right jobs. Because when you trust these people, you gotta do due diligence, right? You gotta select the right person for the right job. Another thing to look at, to kind of realize, is that compensation is always a hot topic, a kind of a sensitive topic. People debate all the time about how much you should be paid, right? Or how much workers should be paid. And there is, a bigger issue with compensation inequality, right? Mm-hmm. Why do CEO or executive get paid millions of dollars in compensation, and you pay your workers, your average worker who actually do their, job to run the business, an hourly wage? And you see that with, questions that are raised all the time at the beginning of the COVID-19 pandemic, right? The CEO of Disney, still keep their pay package and everything while they follow thousands of workers, at Disney. So it's fair to ask the question whether compensation is fair. And if it is not fair, then you create a situation where your employees have an incentive to, manipulate the system or to act, opportunistically, right? Instead of having a good faith and trying to build the companies, to try to act in the best interest of the company. So as a business owner, ask yourself whether you're paying fair, whether you appreciate your workers. I think those are really important in the context of business. Human resource, human management, the interaction among, between you and the owners and the employers is crucially important for a long-term business.
Yeah, so seeing how coming into contact with all these disparities with upper level management and lower level management, what are some of the other newer challenging unanswered questions that you've come up to? Like, how can you solve, and what is next?
I think it's still a very emerging, or not emerging, but I think there are a lot of unanswered questions here. And the usual, what the business has been accepting or the corporate has been accepting is that, this is the governance structure probably their problem or loophole with that structure, but we don't have a better solution. We haven't come up with anything that is better to address that problem. So all firms are trying their best to accept the system as is, and what we've been relying so far is relying on the labor market, meaning, if you have a director who act, recklessly and cause damage to the firm value, then those directors won't be able to find another gig, another job. So the reputation of the directors or the executive, the future prospect of those jobs that they might get in the future are still the main, in my belief, that's still the driving factor that keep them in check. I don't think that the current governance structure is very effective. So that being said, we need to find out, is there a way to measure an output by the directors of the firm? At the top of the firm, it is very difficult to measure output. Let's say you as a worker, right? You got to enter your timesheet, right? You got to go and, they measure you on the amount of sale you make a month, say, for example. So there are easier way to measure output or to tie outputs with compensation at the lower level. But at the top of the firm, right, the CEO, you don't know what they do. Who's going to monitor the CEO? Who's going to say what the CEOs are doing? A director, same thing, right? So it's very difficult to do that kind of output measurement. And how do you explain the compensation, based on the output that they are making? So that's one of the questions that I think is important in the literature or in the general business environment. So how do you measure, output from such a high level of executives? And then once you know how to measure the output, how do you strike the balance between, the advising and the monitoring function of a director? So when you have a board of directors like that, supposedly the CEO reporting to the board of directors, but you don't want the CEO to be intimidated by the board of directors to the point where they won't share any information, correct? Mm-hmm. So you don't want, it's essentially boiled out to the same relationship you have with your boss. They are your boss, your manager, and there's a hierarchy of, actions and authorization. But you don't want your employees to feel like, I don't want to share anything with my boss because he's going to get mad. He's going to fire me or things like that, right? So the directors are if you walk in the shoe of the director, it's a balance between, how do you let the CEO know that they have their supports, but at the same time, they are ready to voice their concerns or their advice or, their concern whenever, the CEO are not on the right track. So struck the right balance between advising and monitoring, and how would you encourage the directors of the firm to walk in the owner's shoes? Be it because think about it, the directors are serving, a 3 years term, 6 years, it's not forever. So still, aligning that interest, I think there's a lot of lacking in terms of how the owners can use that compensation and align the interests of the directors with the investors of the firm.
Very interesting. I didn't even know that whole take on that side.
Yeah.
So we know that the CEO is the face of the company. I think a lot of people do forget that the board of directors are really, really big ones calling the shots. How do you go about overseeing the board of directors' actions? Like, if the owner's not really there, like, to oversee what they're doing, since I guess they can control their salaries and they can do all this stuff. So what measurements are being put in place to stop them from just to have free reign over everything?
So regulationally, the board of directors have to have they have to report to the owners, right? If they don't do their jobs, they are facing lawsuits by the owners of the firm, investors of the firm. So litigations is the main channel where, if you find out that, some directors act, recklessly or did something to harm the firm value, then the shareholders can go and file a lawsuit and kind of sue the directors of the firm and, strip them from the power that they are having, replace them with another with a director that is better serving the shareholders' interests. If you look at, one of the kind of the central or the most talked about governance issue is with Facebook. And the reason is the CEO of Facebook is so powerful. The founders, the owner, the CEO, he got the majority of the control of the company. So in this kind of situation, do you believe that a board of directors can come in and, talk to this Facebook CEO and tell the Facebook CEO what he can do and what he cannot do, right? I don't think that's very feasible, given the amount of control that he has, right? And regardless of what kind of directors that you're talking about, independent, outside directors, or, inside the director. So if you have a firm like Facebook, the board of directors doesn't have an external power towards the CEO. Much like, the power balance is really tilted towards the CEO at that point. So then, Facebook, I think the Facebook investor filed, multiple lawsuits towards the directors of the firm, because it has been documented that, these directors were not acting in the best interest of the shareholders, and they gave the CEO of Facebook a lot more power, or they did not try to negotiate with the CEO to rein in the power of the CEO. So that does happen, and it helps in, if you have, let's say, a director got into a lawsuit like that, it damaged their reputation, right? Nobody would their reputation is damaged. The shareholders, the next company that look at those pool of directors would say, oh, this one has been sued. We don't want anything to do with someone who has a bad track records. So again, the labor market for directors, right? The reputation, the potential for them to go out and say, I've been doing a good job as the director. Networking, all of those kind of contribute to how the directors are actually held accountable for their actions. And really that's the main, I think that's the main mechanism that has been going on.
Yeah, I think it's very important for investors to see that the, actions that are being taken up at high levels of corporations know and see that these do have impacts on who's investing in your company, where your value will go from there, and how your employees will want to be here. So,
exactly.
Yeah, it's very meaningful.
Yeah, because so when inside the classroom, right? I talked about this all the time, because it's one of my passion. It's like everything that we have to do with CEO, managers, all of that dynamics of relationship, I'm very interested in. And the reason is because those are the people who you trust with running the company, increasing the firm value, trying to make the best decision possible. So it's important for you to look at those dynamics. You want to see whether the CEOs are working well with the board of directors. Is there any conflicts of interest? Are you aware of anything that might damage that relationship? When they brought in new directors, are those people bringing in some new ideas, some expertise, anything that would contribute to the advising, the monitoring function of that board? So as an investor, if you think about investing in long term, it's important to care about all of the aspects of business. And so when I talk about this in class, I'm always saying I'm not a day trader. I'm not going to go invest in a bubble stock like GameStop, okay? And so what I want to do is I want to look at the business models. How do these business make money? Will it be sustainable? Will it be easy to scale up? I looked at the management team, right? The track records of information that they have made for that firm in particular for 10, 20 years, 5, 10 years, and see whether they are strategically did the right thing. Look at all the directors that surrounding that CEO. They have the expertise, what kind of experience they have that can contribute to the firm. So fundamentals does not stop at just accounting numbers. I always look at the business model, the management team, the dynamics between the board and the CEO, whether the boards pick the right type of person for the job.
Yeah, and definitely making sure that you have an eye out on all those categories make for a better investment in the future.
Exactly.
So.
Yes. So in the middle of all these chaotic, actions, the market goes up and down. I was just sitting there and watch the news and think, okay, fine. This had nothing to do with my portfolio, or, my portfolio is fine. So maybe, it's a good time to purchase more of the thing that I'm holding already, or things like that. Yeah. So yeah, if you want me to do, or if like my husband, he's always just watching stocks and activities and things like that. If you want me to do that, I can't, because I'm like, I don't have time for that. I have a kid, I have a husband, right? I have a house and etc. But I'm more of a long-term value investment, and it has to do with, and I always start with the business model and building up from there.
Yeah, I definitely can say the same about my investment strategy approach for sure. Long-term plays.
Yes.
But
we need more people like us,
definitely.
So the market could be more stable.
I know. Through the whole GameStop situation, I was going through and looking at seeing what other industries were trading at very high volumes while everyone was just paying attention to GameStop. I was like, okay, well, what's going on in the semiconductors or clean energy side? And so I can say that my portfolio has been doing pretty well.
Yeah, of course. And I have a funny story. So my sister-in-law's husband actually invested in BlackBerry years ago. And at that point, I was thinking, BlackBerry, they are out of business. There's no future to that company whatsoever. And they bought in because it was dirt cheap, stocks. And so a couple of days ago, they called me up and they said, oh my God, we made, a couple of thousand with BlackBerry. And I'm like, okay, sell it. I said, you got to get out of it. Because that's the opportunity of a lifetime to get out of that investment. That's, the day that you've been waiting for. And soon enough, I figure, BlackBerry was one of the stock that were involved in that,
public
the GameStop and AMC things. Yeah, so I figure, okay, so if you can look at that and go, why are these stocks the target, right, of those run? They potentially look at the fundamental of those companies. You don't see any future, or not any future, but I mean grim, right? It's a grimmer future. So that's explained, why these short sellers are shorting these stocks, because they know that these companies have the potential to go even down further. So it's wrong for Robinhood, for example, to stop trading of those stocks. But I definitely don't think it's a good idea to bet against the fundamentals of these companies, because eventually it will come out to be, that the fundamental doesn't improve. Yeah, and you got to go back to realizing the reality.
Do you think that short selling a stock like that is in a way further pushing GameStop into a possible bankruptcy, if that was their plan when they did envision shorting the stock at 140%?
No. So the activities of the traders, they have nothing to do with the company's financials, fundamentally. So once the stock is listed, it is traded on the market, it's floating on the market. So all of the activities that you see is actually not beneficial directly to the firm. The downside of all of these is really the cost of borrowing or the cost of capital for these firms, right? If you have a stock that have been doing so much, doing so good, and your investor expecting higher return from these stocks, then that does impact the cost of borrowing, the cost of equity for those firms, and that impact their projects and their fundamentals, financials. But all of these buzzing about how the stocks are trading, it doesn't directly impact the company in a fundamental way. Yeah, it just create all sorts of trading frenzies that would cause chaotics. And now at this point, if you look at a share of GameStop and what they are doing fundamentally, the CEO of the firm would probably say it has nothing to do with me, because it doesn't reflect the fundamentals of the firm. So I have no control over that process, right? It's just really just the result of the market manipulation.
Yes, definitely. you just look at the stock charts, you can tell it's very blatant that there was something going on Thursday or Friday of last week, where you just saw the huge dip in that one stock price. Because if it's going to be a free market, it should be a free market for everyone, even if they haven't learned to not have an emotional attachment to their money. But if they like the stock, they should be able to buy it.
Exactly. I think it's wrong to restrict the trading of the stock. It doesn't make sense to me at all. If you're the free market, you gotta let the market work, right? So either you see that spectacular run and that enrich a small numbers of investors, fine. That's how the market works. So
last question, just to wrap it up a little bit. So do you think now GameStop, with its new fueled up, pumped up stock, has the potential to do a little bit of change, possibly with its corporate governance, to maybe pull itself out and be the future of video games? Or do you think this will be just kind of like a small thing for them?
Well, so if you look at the business model, right, of that firm, it's a retail business. And for with any retail business, at this point, before COVID-19, it has been a downward spiral for them, because if you look at the business model, you gotta, for GameStop, say for example, you gotta draw people into the store, make purchase, and that include, video games, CDs, gears and things like that. Personally, I think GameStop still has some edge in terms of distributing, games and, things that are related to game physically, hardware that you need. The game section, which is the actual game that you play, that will go away, because now we don't have to have a physical CD you have to put into that machine anymore. You just exactly. So imagine GameStop. So imagine Blockbuster, right, or Netflix in the past, where their business was built on the selling of the CD, of the content. That would, if GameStop were that company, they will certainly collapse. But now the good thing, a better thing about GameStop is they have a gaming devices. They have the hardware part of their business, and I think that will still survive for probably the next 5 years. Into the future, into the future, you will see that I would expect that their business, would gradually decline if they don't find another edge, another, take on the current business model to make real change. Because if you look at, so go back and look at how Blockbuster has been going out of business. Compare it with how Netflix has been striving, right? Because Netflix has known for so long that, selling content on a CD is no longer feasible. So they have moved everything towards streaming. And what better is that they now create content, because that company cannot depend on other people's content to stay competitive. So if GameStop can somehow learn from that, I think they still have time. They won't go out of business right away. They still have time. They still have the edge in, gaming hardware distribution, and maybe they can turn that into something better. But again, that's a very competitive market to be on, because we have Best Buy, we have all sort of retail store that can carry the same hardware, right? So now the key thing with GameStop is, are they able to make their business a unique place for people to come? Like, just think about Apple Store, right? Can you drive these gamers who love games, who love to interact with their hardwares into the store and make purchase the way Apple does with their products? If they can do that, then I think they survive.
Yeah, I'd definitely be interested to see what kind of innovation, creative destruction they pull out to possibly target their segment just a little bit more specifically. So,
yeah.
Well, thank you so much thank you so much for your time today.
Thank you for having me. It was great talking to you.
I hope you've enjoyed learning more about this particular topic, and we'll see you next time on the next installment of Research That Matters.